Welcome back to the channel, everyone. Today I want to talk about why Citadel are currently very scared and why they are so close to being margin called. So stay tuned and let's make some money. But before I dive into the video, if you haven't already, be sure to sign up to Moomoo using the special Thomas James Investing promotion, which, by the way guys, it does end soon. Not only do you get a free stock worth up to $350, and not only do you get a second free stock with a guaranteed value of $50, but you also get a third free stock with another guaranteed value of $30 on top of that. So that's at least $80 in guaranteed free shares just for signing up with Moomoo and depositing at least $100. You can sell those free shares and basically get 2 entirely free shares of AMC, linked in the description below. And I want to dive straight in with the key information. So, I am very excited right now. Do you want to know why? And it's because Citadel is scared. It's obvious that recent legal filings have shaken them, and I want to talk a little bit about how this relates to the mother of all short squeezes, as some of you baby apes seem to have a set of blinders on with respect to the larger implications here. So let's break it down. In this post, I want to briefly discuss a few things: the actual legal filing, Citadel's Twitter storm and what it could mean, a rundown on margin calls, and a reminder of who pays for the mother of all short squeezes. Now, I don't really want to talk too much about the legal filing as I have covered it in some of my previous videos, but one thing that I did find very interesting is that Apex Clearing actually filed to dismiss this lawsuit, but on September 23rd, that dismissal was denied. And then we've also got Citadel tweeting like an angry teen girl, which again I also don't want to talk too much about as I've covered it in my previous videos. But the main meat and potatoes of what I want to talk about today is Ken Griffin in Citadel stupidly leveraged? I want to look at an article I came across from February this year on the site Wall Street on Parade. In it, the authors note that Ken Griffin gave incorrect or perhaps intentionally misleading information to Congress when he was asked about the assets of Citadel. A congressman asked Ken Griffin how much money was managed by his hedge fund, and Griffin replied, "We manage approximately $35 billion of assets." The congressman then suggested that Citadel was systematically important, but Ken Griffin quickly responded with this: "I believe that our hedge fund would not be in the category of systematically important. With 30-something billion dollars of equity, it's simply not at the scale or magnitude of a JP Morgan, Bank of America, or Wells Fargo." And therefore, in his first response, Griffin said that Citadel managed 30-something billion dollars of assets, but in the second response, he changed that to 30-something billion of equity. Now, according to the Form ADV, or the 13F, that Griffin's hedge fund, Citadel Advisors, filed on January 15, 2021 with the SEC, his hedge fund is managing not $35 billion, but $235 billion. To be very specific, $234,679,962,503. And therefore, while Citadel only has 30-something billion of equity, Ken Griffin is leveraging that money and borrowing lots more money, and he has lots of loans from external parties, and therefore he's managing 234 billion of assets. And therefore it makes it highly likely that other large institutions and banks like JP Morgan, Goldman Sachs and Citigroup are providing margin loans that have helped Citadel Advisors leverage its equity from 35 billion to 235 billion. And as you can see by this graph here, it means that Citadel is leveraged 8.1 times more than its assets under management. But how exactly does this all tie together? Well, we can see that the market cap of AMC is around $19.56 billion. Let's round that up to $20 billion. But we also know that the float is sold many times over. So let's say the true value of those synthetic shares out there totals to around $100 billion. So that's assuming that the float is sold 5 times over. So assuming that there's 2.5 billion synthetic shares, or maybe 2 billion synthetic shares, and the original 500 million real shares, 2.5 billion total shares. Now obviously we know that Citadel aren't the only player in this game. They aren't the only hedge fund that's shorting AMC, and they aren't the only hedge fund or institutional market maker that's creating those synthetic shares. But let's assume that Citadel is doing most of the damage. Let's say 50 or 60 billion, for example. So we've got Citadel's total assets under management of $235 billion. Maybe 50 billion of that is segregated for their AMC short position, which leaves 175, 185 billion for all of their other long positions and all of their other short positions as well. Now we know that the rest of that cash from their 13F is tied up in a number of stocks like Tesla, Amazon, Apple, Facebook, Nvidia, and many, many more. So typically, if you're trading a stock and you're long on a stock with no margin, that stock has to fall by 100% to zero for your position to be liquidated. But obviously, if you're trading on margin, let's say you're only using a 2x margin, that means the stock only has to fall by 50% for you to be liquidated. Now, if you're trading on an 8.1 times margin like Citadel is, that means your long positions only have to fall by a mere 12% for the entire fund to be liquidated. So if there was, say, some kind of event around the corner, like a market crash, that might cause Tesla, Amazon, Apple, or Nvidia, or many others to fall by 12%, then Citadel would be in a lot of trouble and would be margin called. Now, we also know that the S&P 500 is already down by 5.3% over the last couple of weeks, and therefore it actually doesn't really have too much further to fall before Citadel actually end up getting liquidated. Now, on top of this, some of their stocks like Apple have already fallen by 10.1%, and therefore Citadel is actually very, very close to being liquidated. Now, let's go back to the post. The collapse of Enron, Bear Stearns, and others. I'm going to swing your attention back to 2008, and I promise all of this will come together and make sense soon enough. I want you to recall some of the biggest investment fund disasters of all time. Enron, Lehman Brothers, and Bear should immediately come to mind. Beyond corruption, all of these firms have something in common with respect to their collapse, namely the improper marking, leverage, or restriction to access of client funds. But another key factor of similarity is what exactly ended up contributing in a huge way to their demise: clients running away at the first sign of major trouble. And obviously this is what's known as a run on the banks, when investors take out their money faster than the investment funds can handle it, and they can't sell off their positions quick enough, and end up running out of cash because the investors withdraw everything. Firms tend to get very vocal, very insistent, and very loud about nothing being wrong when their clients start asking, "What are you doing over there with my money?" In Citadel's case, I would imagine the court filings mean a lot more than just speculation about an inappropriate relationship with brokerages. To their clients, it likely looks like Citadel's house of cards is beginning to falter. And what does that mean for them? The possibility of their money being locked up by lawsuits, by investigations, or even by bankruptcy. And therefore, this is why Citadel is getting so panicked over on Twitter, because there's so much public media attention on them lying. Many of their investors are going to think, hang on, Citadel's lying, everything is not fine, my money is not safe, I need to get it out now. So let's tie it all together. We've got a lawsuit that's begun to reveal important documents fully validating and demonstrating the theory that Citadel has been engaging in unethical relationships across Wall Street. We've also got Citadel lashing out for the first time in 9 months in a desperate flurry of badly done PR. We've got an overall market that's getting increasingly unstable, threatening Citadel's profitable plays. We've also got Citadel wound up in some very problematic short bets that they cannot properly unwind without a major liquidity crisis. We've also got Citadel already over-leveraged and stretched beyond their means with an 8.1 times leverage ratio. We've also got apes who are most definitely not leaving the short bets, especially not with today's move. So therefore you need to recall that the squeeze would have happened in January, and it was only stopped because Citadel and Point72 stepped in and propped up Melvin Capital. They didn't do this out of the goodness of their hearts, they did it because if they hadn't, they all would have fallen. The domino would have been flicked and the chain reaction would have been set off. If Melvin Capital had to cover their entire short position, then Citadel's short position would have moved negatively so badly against them that they wouldn't have met margin requirements and would have been margin called. Now, something that also proves just how scared Citadel is is Ken Griffin and Citadel slamming Cat Striker with a lawsuit. Cat planned to pay another flight display company to fly a banner over Citadel's headquarters and do many loops around it. But she's just had a legal letter from Citadel's solicitors basically saying that this is a very bad idea and they'll sue her for defamation of character. I'll leave the link to this lawsuit down in the description below so you can give it a read for yourself. But basically, and obviously, Citadel allege that Ken Griffin and Citadel have done nothing wrong and therefore it's defamation of character and therefore it shouldn't go ahead. Now I also want to talk about the president of Robinhood literally admitting to insider trading in internal communications. That's included in that lawsuit discussed earlier in the video. Robinhood Securities' president and COO, James Starwalt, who Tenev points to as making the ultimate call to PCO, said in an internal chat on January 26th, "I've sold my AMC today, FYI, tomorrow morning we're moving GameStop to 100% and position close only, just so you're aware." And he also decided on the morning of January 28th to PCO the top 4 symbols AMC, GameStop, Nokia and BlackBerry, despite acknowledging we aren't paying $3 billion worth of security. So therefore the Robinhood Securities president fully well knew that they were moving AMC and GameStop to position close only and limiting the margin trading on those stocks, and therefore he sold his AMC shares in advance. As Trey says, I can't underestimate how completely insane it is that this happened, and that it's insider trading to a T. Now I also wanted to recap on today's reverse repos because they are absolutely mad. You can see that for many days and weeks now, the reverse repo facility has been fluctuating between 1 trillion and around $1.3 trillion. Now obviously yesterday this increased massively to 1.4 trillion, but today it increased to $1.6 trillion. And the number of parties jumped from around 70 to 80 all the way up to 92 individual parties. We've also got a big impact again on the treasury balance, bringing it down from $217 billion back down to around $172 billion. Guys, be sure to let me know down in the comments below what you think about Citadel Securities being so close to a margin call. And if you haven't already, be sure to sign up to Moomoo using that special Thomas James investing promotion. All you've got to do is sign up, open an account, and deposit at least $100 to get at least $80 in guaranteed free stocks. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.